First, welcome to the video. Today we will cut through the noise of get-rich-quick advice and show a simple, practical path to real financial freedom. We will focus on income, avoiding toxic debt, simple investing, budgeting, and key life choices that impact your wealth. Now let's set the stage for why this matters right after the agenda. Next, the reason this topic matters is that early decisions compound powerfully over time. Small edges in income, debt avoidance, and simple investing can create large advantages. Meanwhile, chasing hot tips and complex trading can lead to losses and stress. Therefore, we will keep things simple, evidence-based, and actionable. Before diving in, here is our roadmap. First, we will examine why get-rich-quick advice fails. Then, we will prioritize income and debt strategy. After that, we will budget and invest simply. Finally, we will cover major life decisions, summarize an action plan, and test your understanding with short quizzes. Now, a quick disclaimer. This content is for education only and does not constitute financial, legal, or tax advice. Your situation is unique, and you should research independently or consult a qualified professional before making decisions. With that said, let's expose the pitfalls of chasing scams. First, many online promises of fast riches are marketing, not a proven system. The reliable approach is slow and steady. The controversial truth is that your first and best investment is increasing your earning power, because higher income gives you more surplus to save and invest. Concurrently, high-interest debt works against you and can negate early investment gains. Therefore, avoiding or rapidly eliminating toxic debt is critical. Finally, simple passive investing with broad market index funds tends to outperform most complex strategies for beginners due to diversification and low costs. With this foundation, let's illustrate your overall path with a diagram. Next, this flowchart visualizes the journey from graduation to financial freedom. You begin by entering the workforce and focusing on skills and income growth. If high-interest debt is present, attack it first. If debt is low interest and manageable, you still prioritize building an emergency fund. Then you start passive investing in broad index funds, or ETFs, and automate contributions. By keeping lifestyle inflation low as your income rises, you generate consistent surplus for investing. Repeating these steps compounds results and moves you toward financial freedom. Now, we focus on income. Your earning power dictates how much you can save and invest. Choose skills and credentials with strong demand and solid pay, considering trades, certifications, and degrees with high return on investment. Build a portfolio through internships and projects. Always negotiate offers based on market data, including salary and total compensation. Consider a simple side hustle to accelerate savings. The included checklist provides a practical 3-step plan to identify roles, map skills, and execute a 90-day portfolio plan. Next, this table shows illustrative examples of education and training return on investment. Costs and salaries vary by region and time, so treat these as rough estimates only, not guarantees. The takeaway is to prefer paths with strong demand, manageable costs, and short payback periods. Always research local data and verify outcomes before committing. Meanwhile, high-interest debt destroys progress. Use a prioritization strategy such as the debt avalanche by making minimum payments on all accounts and directing extra cash to the highest interest balance first. Consider refinancing to lower rates when it makes sense and does not introduce hidden costs. Build an emergency fund to prevent new debt when life happens. The diagram shows how to triage debts by interest rate and attack the worst first. With debt under control, let's structure your spending. Next, this pie chart proposes an aggressive but realistic budget for a new graduate. Essentials consume half your spending. Fun remains present, but limited at 15% to avoid burnout. Dedicated learning at 5% keeps your income growing. An emergency fund receives 10% until fully funded. Investing takes 20% and can grow as your income rises while you hold living costs steady. Now, build your budget. Start by listing your take-home income and fixed bills. Then, track all expenses for at least a month to reveal patterns. Set target percentages and automate transfers to savings, emergency fund, and investing. Intentionally keep your lifestyle close to your student level for 1 to 2 years to create surplus cash flow. Review weekly and make incremental cuts to small leaks. Next, Once your high-interest debt is under control and an emergency fund is in place, begin investing simply. Choose broad market index funds, or ETFs, that track a large segment of the market, such as the 500 largest U.S. companies. These provide diversification and low fees, automate contributions and reinvest dividends. Avoid complex trading and speculation early on. Consistency and time in the market are your allies. Now this timeline lays out milestones. In the first year, build an emergency fund, eliminate high-interest debt, and start small, automated investments. In years 2 and 3, upgrade skills to secure raises or role changes, and increase contribution rates. In years 4 and 5, keep lifestyle inflation low, maximize tax-advantaged accounts if available, and build optional side hustle income. Throughout, review and rebalance annually. Next, we contrast index funds with stock picking. Index funds offer diversification, low fees, and easy automation, which lowers risk and workload. By contrast, stock picking concentrates risk in a few names, often requires significant research time, may introduce higher trading costs and taxes, and makes it harder to consistently outperform the market. For most beginners, index funds are a simpler and safer starting point. Moving on, this mind map centers on income growth. Branches include skills, credentials, a demonstrable portfolio, networking, negotiation, and side hustles. Each branch feeds the same goal: raising your earning power so you can save and invest more with less stress. Strengthening any branch increases your options and resilience. Next, wealth building is not only about offense. Keep lifestyle costs deliberately low as your income grows to create surplus. Additionally, the choice of a life partner has major financial implications. Misalignment can lead to conflict and potentially expensive separation. Discuss money values, budgeting, debt, and investing early to ensure alignment before major commitments. Now it is quiz time. Question: what is the best first investment for a new graduate aiming for long-term wealth? Option A: day trading hot stocks. Option B: maximizing earning power through skills and career growth. Option C: buying luxury items to build credit. Option D: borrowing to invest in crypto. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Next, the correct answer is B: maximizing earning power through skills and career growth. This approach increases your ability to save and invest consistently, which compounds over time. Now for the second quiz question. Why are broad market index funds, or ETFs, a strong starting point for new investors? Option A: they guarantee profits. Option B: they offer instant diversification at low cost and are easy to automate. Option C: they let you time the market better. Option D: they eliminate all risk. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Next, the correct answer is B. Broad market index funds, or ETFs, provide diversification with low fees and are easy to automate. This combination reduces errors and supports consistent long-term participation in the market. Now, let's recap the core ideas. Build your income engine by acquiring valuable skills. Avoid toxic debt and prioritize repayment by interest rate. Budget carefully and keep lifestyle inflation low. Invest simply through diversified index funds and automate contributions. Finally, make thoughtful life choices with partners who align on financial values. Finally, here is a simple action plan. Choose a high-return skill and begin a 90-day build plan. Catalog all debts and attack the highest interest first while maintaining minimums. Build a starter emergency fund and then expand it to 3 to 6 months of expenses. Open a low-fee brokerage account and automate monthly investments into a broad index fund, or ETF. Keep your lifestyle stable for 1 to 2 years as income rises, and commit to weekly reviews and an annual rebalancing session. As we wrap up, thank you for watching. If this video helped, please like, share, and subscribe. In the comments, share your first step and your 90-day plan so others can learn and support you.